Ever get the feeling that the 2026 economy is sending some seriously mixed signals? Well, if you do, you are definitely not alone. In this explainer, we're going to break down the powerful forces that are pulling everything in opposite directions and try to figure out why the road ahead feels so unstable.
So, let's start with that question. Why is it all so confusing? I mean, you hear about a booming stock market right alongside stories of real kitchen table anxiety. You've got massive companies hiring while small businesses are struggling to keep up. It feels like for every piece of good news, there's a piece of bad news waiting right around the corner. This isn't your typical economic cycle, and to really get it, we need to rethink a word we hear all the time.
And this slide right here really gets to the heart of it. It's the difference between uncertain and unstable. We always hear that the market hates uncertainty, right? But some great analysis from Charles Schwab suggests unstable is a much better word for 2026. See, uncertainty is like driving in fog. You know the road is still there, you just can't see very far ahead. Instability, that's when the road itself is cracking and shifting right under your tires. The economy isn't on one hidden path, it's on a bunch of different paths all at the same time.
And this idea of multiple diverging paths, well, it brings us right to our first major theme, the K-shaped reality. Honestly, it's the perfect way to picture this unstable economy.
So what exactly is a K-shaped economy? It's pretty much what it sounds like. Just picture the letter K. After some kind of downturn, one part of the economy shoots straight up. That's the top arm of the K. But at the very same time, another part trends down. That's the bottom leg. They're literally moving in opposite directions from the exact same starting point.
And this isn't just some abstract theory. We're seeing it everywhere. Huge corporations are hiring, but data from ADP shows small businesses have actually been cutting jobs. People who own assets have a pretty sunny outlook, while wage earners are feeling that constant crushing pressure of affordability. This split, this divergence, is the core story of 2026. But as we're about to see, the roots of this thing run deep.
Yeah, this K-shape is not some new phenomenon. Just look at this chart. The economic power of the middle class has been eroding for decades. According to U.S. Bank, back in 1970, the middle class took home 62% of the nation's income. Fast forward to 2022, and that share has plunged to just 43%. This instability we're feeling now, it's just pouring gasoline on a fire that's been burning for 50 years.
Okay, so what's fueling all this instability? Well, that brings us to the big problem that's making everything so complicated. Stubborn, sticky inflation, and the really tricky spot that the Federal Reserve in. So, while inflation has definitely cooled off from its crazy highs, the forecast suggests it's going to settle somewhere around 3%. Now, that might not sound like a lot, but it's still stubbornly above the Fed's 2% target. And believe me, that one little percentage point makes all the difference in the world for their policy decisions. So why can't we shake this inflation? Well, the research points to three main culprits. First up, we've got persistent tariffs, which are basically taxes that just make things more expensive. Second, the services part of the economy is still running hot, keeping demand and prices high. And third, and this one is wild, budget cuts at the Bureau of Labor Statistics mean that a record 40% of the items in the Consumer Price Index are now just estimated, not directly measured. That makes it really hard to know what the true inflation picture even is.
This whole situation puts the Fed in a real bind. I mean, on one hand, that sticky inflation tells them they need to keep rates high. But on the other hand, you've got a softening, kind of wobbly labor market, which tells them they should cut rates to help out with jobs. The result? A deeply divided committee and a general forecast for maybe just 2 or 3 small rate cuts in 2026 as they try to walk this incredibly thin tightrope.
Now, while all these traditional parts of the economy are wobbling, there is one area that is absolutely on fire. It's acting as this powerful engine for growth, but it comes with a potential hidden risk. And you know what I'm talking about, artificial intelligence. Okay, so this slide shows a fascinating risk in the AI boom that some are calling circular financing. Let me break it down. It works like this. A big AI infrastructure company, say a chip maker, invests a ton of money into a new AI startup. That startup then turns around and uses that exact same money to buy chips from that very same company. So the supplier's revenue shoots up. But is it from real organic demand, or is it just their own money coming right back to them in a loop? It's a real concern that this could be inflating valuations, kind of like the vendor financing we saw right before the dot-com bubble burst.
And all this leads to a huge theme for 2026, a potential rotation within the AI market itself. The early days were all about the AI enablers, the companies building the foundational chips and the cloud platforms, but the focus is starting to shift now to the AI adopters. These are the companies that are actually using AI to get real, measurable results and become more efficient. That's where a lot of analysts think the next big wave of value is going to come from.
So let's pull all these threads together. We've got a K-shaped reality, we've got sticky inflation, and we've got this wild AI boom. What does all this instability actually mean for the market and for all of us as investors?
Well, the general outlook is actually cautiously optimistic. With corporate earnings looking pretty solid, the analysis suggests that stocks can keep grinding their way higher, but, and this is the really important part, it is not going to be a smooth ride.
That instability means we should expect some sharp swings and a lot of churn. Churn just means different sectors are going to be rotating in and out of favor really, really quickly. So yeah, the path upward is probably going to be a pretty bumpy one.
So in a market like this, what's the game plan? Well, the advice seems to center on a few key themes. First, learn to embrace the volatility. Maybe instead of rebalancing your portfolio on a set date, you do it when the market makes a big move. Second, diversify. The gains are expected to spread out beyond just a few giant tech stocks. And finally, focus on quality. In an unstable world, you want companies with real profits and strong balance sheets that can weather any storm.
And if you want the perfect illustration of this K-shaped world, just look at the commodities market. It's amazing. Check out these forecasts from IG International. You've got a bullish call on gold, a very bullish call on silver, mostly because of industrial demand for things like AI and solar, and at the exact same time, a bearish forecast for oil. It's a perfect snapshot of an economy moving on multiple, totally contradictory paths.
And all of this brings us to one final, really critical question. The economy isn't on a single track anymore. It's this complex web of diverging paths. Some are rising, some are falling, and it's all happening at once. So the real question for 2026 isn't just where's the economy going? It's in an economy of multiple paths, which path are you on?